want the markets to come down. That list is also increasing. So it's a constant feature in this bull market. Prices are going higher and disbelief is at its peak. Sunil Singhania joins us. We are discussing our brand new series, he's part of a brand new series which we just started, Greed or Fear. And the question we would discuss, deliberate, is that at 60,000, how should an investor approach this market? Are best of the gains behind us, or are we in for a structural bull market, like a market what we saw, or like a market what we've seen in US in last 10 years? How different will 2021 be from 2020, and which are the pockets where he's identifying value? I'll also remind our viewers that Sunil loves to follow this formula of 15-15-15, which is buy 15% growth, 15% return, but at a P of 15. Where are some of these stocks available in this market which offer 15% growth and at P of 15? We'll talk about that. Sunil, fantastic to have you back. Thank you for joining us.
Thank you. Thank you, Nikunj. Good morning.
Are you looking slightly tired, or it's a camera trick?
I am definitely not tired, as charged up as always. It's Friday. So all of us are looking forward to the weekend.
Sunil, my question is very simple. At 60,000, how should one take a medium-term view on the market? Because we are right now in a market, we are now witnessing a market or a bull market like never before. We've not seen a correction at all. Predicting the market and predicting the market correction has been futile. So rather than predicting the market, how should one prepare their portfolio if a correction kicks in?
So, Nikunj, we have seen this many times before. Markets have their own sort of a behavior. And the fact of the matter is that we have come out of a period where things were looking down and out completely. And from there, in fact, things have turned out much, much better than what all of us expected. In fact, as we speak, there is so much optimism, not only in the few sectors which we used to see maybe 3, 4, 5 years back, but across the spectrum of the country. On top of it, obviously, the liquidity has also helped. So I think we are in a period, and we are heading into a period where growth looks like surprising. We have near-term headwinds coming in terms of rising input costs. But I think the demand scenario is so good that you're able to pass on a lot of these increases. On top of it, obviously, you have a little bit of retail, I would say, interest which has reignited, and that also is leading to pockets of maybe overvaluation as far as the markets are concerned. So we are heading in for a good and interesting time. I think this milestones of 50,000, 60,000 are obviously big milestones. But just because the market is at a particular milestone, we should get bearish or bullish. At least I don't subscribe to that notion.
Great point. Sunil, what are the chances that we could be in for a bull market like never before? And I'm just going to throw some perspective here for our viewers, that normally we've seen a bull and a bear market cycle, they last for 3 to 4 years. But Sunil, what are the chances that we could be in like a bull market, what we have seen in United States, a 10-12-year-old bull market and still alive and kicking?
So, Nikunj, I think we always try to, mistake ourselves and get swayed by data points, So, market at 60,000 is a warning signal, for example, or P of X is a warning signal, and so on and so forth. And I think you rightly said before you came to me that people are trying to find mandi in this market. And I think the biggest strength of this market has been the frequent but small corrections. Every month we have this 4-5% correction. Every month we have some of the other things which sort of make us cautious, whether it is taper tantrum, the China issues, Evergrande, and so on and so forth. And I think that is what is making the market very healthy. We are still in a scenario where most investors are looking for a correction to enter the market rather than looking at an upside to exit the market. And I think that makes this market very healthy. On top of it, there are a lot of tailwinds. Tailwinds, as I said, from fundamentals. Tailwinds also from a never before initiatives from the government. Privatization, we have already hopefully seen, the airline being privatized more on the anvil. We are finally seeing private capex coming back, largely led by, demand coming in across the sectors. And for a change, our exports are also looking to be quite healthy. Yes, there are, near-term, I would say, speed breakers in the sense you have a logistics issue, you have, energy costs which are going up across the world, you have raw material costs which are rising. There's a lot of volatility. It's easy to be an investor today, but it's very difficult to be an entrepreneur or a manufacturer because of the varied variables they have to manage. But I think all said and done, we are in a decent sort of move. Now, whether this lasts for 3 years, 5 years, 10 years, we don't know. Whether there will be correction, there will definitely be correction. But I would say that India has been in a decent phase for the last 20 years. Despite all the ups and downs which we have seen, I think the last 20 years returns have been phenomenal. So, I think we're already in a good sort of a scenario, and there is no reason for us to believe that the next 5-10 years are also going to be quite interesting and beneficial for investors.
Sunil, markets are ultimately nothing else but a reflection of economic growth, and they try to adjust where the economic growth will be higher and lower, and where the profit pools are increasing and decreasing. Based on where we stand right now, if you have to talk about 2 or 3 large profit pools, whether it's cyclical or whether it's structural, what are those profit pools you are excited about?
So, in a growing economy, obviously, financials are a big segment. Even in India, it's almost 35% of our economy. And we had a scenario where last 4-5 years, for varied reasons, there were a lot of provisioning which used to happen, particularly in financials which were focused towards maybe the non-retail side. I think that provisioning is reducing. And on top of it, you have a scenario of excess liquidity or adequate liquidity, and whereby your cost of deposits are coming down. So I think you are having a scenario where you're able to, pass on that benefit by way of lower, advance interest rates, and which is getting reflected. Mortgage rates, you are able to afford it at 7% and below. And so the demand is also coming in. So I think this profit pool coming in from the financials will be very significant over the next 2 years. Same would be the case with the so-called, forgotten sectors, whether it is metals or, capital goods, or even, from utilities and power sector. So I think the profit pool, a big change will come from there. However, the good thing about India is that we are very diversified. We have presence across sectors, and almost all the sectors are looking like, in a good spot. So you'll have the old favorites like IT and pharma chugging along. You have the new sort of, I would say, chemicals, but not on the specialty side, but on the bulk commodity chemical side, which was expected to do very, very well. And then you have your, economy-related sectors, as I said, whether it is cement, steel, capital goods, which will also contribute. So, from our side, for the next 2 years, there's a possibility of earnings cumulatively going up by 50% compared to where we were in March 21, as a whole, market as a whole.
Okay, if you expect earnings to go up by 50% from here and on an aggregate basis, how much of the earning uptick is already in the price? Because the fact that earnings are coming back is old news. The fact that India is doing well is yesterday's story. The fact that margins will expand for commodities and for real estate companies is again yesterday's headline. Markets always move on tomorrow's headline.
So Nikunj, you are right. These are all yesterday's headlines, but still investors have not believed those headlines. There was always a question mark because of what we went through over the last 5 years. So everyone at the back of the mind thought that, this is possible, but this might not happen. And I think as a result of which, instead of investors investing, at every rise we have seen money being taken off the table by and large. However, having said that, I think to some extent you are right. We are not cheap. We are maybe, according to our calculation, somewhere in the region of 20 to 21 times FY23. But at the same time, there's a lot of disparity in the market. So, on one hand, you have stocks which trade at 100 P multiple, and on the other hand, you still have stocks where the growth is trading at reasonable valuations compared to their long-term averages. And I think that is where we are focusing on. The other thing is it is possible that, earnings might strengthen as we move forward. We are already seeing a significant change in the world or global dynamics. China, we all know, is the villain of the world. There is a little bit of move away from China. Some of the sectors from India, whether it is metals or textiles or even engineering, are benefiting because of that. And we are also seeing finally a scenario where in India, this Make in India is becoming a reality, whether it is because of PLI, whether it is because of added import duties, or it's increasing demand. I think Indian manufacturing finally is also seeing signs of coming back to life. And the entrepreneur spirit, which to some extent had ebbed, between 2015 to 2020, that also is showing signs of coming back to life. I think across the board, entrepreneurs are looking at expansion. There's a lot of money available, both from the fixed income side as well as risk capital in the form of equity. The private equity scene in India is thriving. We already have 31 unicorns as we speak, more on the anvil. And I think that all leads to capital formation as far as the domestic economy is concerned. Interest rates are low. That is rekindling demand for housing, for automobiles. And again, there is a multiplier effect because of that. Job scenario is pretty exciting. So I think all these things can surprise as we move forward. The only one thing I would like to add, and we should not be looking at making 30, 40, 50% every year from equity markets. I think in a scenario where you're making maybe 3-4% net of tax from your fixed income, anything which is double-digit returns in equity market should be excellent returns as we move forward.
Sunil, in this new series, Greed and Fear, I'm asking one question which in a sense is the central theme. And for our audience, that question in a sense could be reflective of your market, market trend. By the time this bull market ends, 3-4 years, we don't know. But on a scale to 1 to 10, what are the chances that we could be in and around 1 lakh on the Sensex or even above that?
Nikunj, you started asking me that, or you made the comment that markets are a reflection of GDP. We are at $2.7 trillion of GDP. I don't think we are going to stop at $5 trillion. We are going to go much ahead. Maybe it might take 15 years, 10 years, I don't know. But we are surely headed towards the 10 trillion as far as economy is concerned. And if we head towards that, and if the market just mimics that, then we are over a period of time going to be much higher than that. Obviously, as I said, markets are like cardiogram. They will always be ups and downs. And as investors, long-term investors, we have been prepared for that. And in fact, whichever investor has, accepted that are the investors who have benefited the most out of this. So I would not hazard a guess. I think as long as the economy continues to chug along, the markets will also keep on chugging along.
Okay. You bought into metal stocks in the past, given what is happening to China on the energy front and also on the entire ESG front. How do you see metal as a category moving?
So on the climate side, I think things are for real. There's a big summit coming up in Glasgow in November, and I'm very sure that almost all the countries who are participating, the 26 large countries, are all going to pledge towards the net zero sort of promise, because ultimately we are seeing what is happening in the world in terms of climate changes. And I think that is going to increase the cost to a certain extent, or everyone will have to ensure that they follow the best environmental practices. And I think to that extent, we have to be prepared for a slight increase in the prices of almost every commodity. As far as metals are concerned, I think Indian companies are in a good sort of a wicket. We are quite, I would say almost fully backward integrated. And the last 1.5 years of a good market has ensured that the balance sheets have also come back into shape. So from like a 5 to 6 debt to EBITDA ratio, which Indian steel companies, for example, had, we would be like 1:1 debt to EBITDA by the time we end financial 22. And that's a big change. And that makes them very competitive. So, with our own iron ore, almost 80-90% domestic coal, good integration in terms of other inputs which are required. And the China obviously facing pressure because of environmental issues. I think this segment seems to be in a pretty decent kind of a scenario. The only thing is, they are commodities and deep cyclical commodities. And I think it is advisable for every investor to limit their exposure in their overall equity portfolio to these kind of deep cyclicals.
The second sector which you've always liked and where we've argued in the past is IT. You've been an IT bull irrespective of what challenges IT companies have had to face. Now it looks like it's clear blue skies for IT stocks. Where are IT stocks headed? Growth is there, return ratios are perfect, and again they are doing buybacks and giving fat dividends. Can IT stocks, the large cap IT stocks, give double-digit returns from here for next 2-3 years?
So, Nikunj, it is very ironical, there is this concept of quality stocks in India. I would say the IT sector is the biggest quality sector in India. Global competitiveness, very great businesses headed by very, very good promoters, up there in terms of giving back to the shareholders by way of large dividends or buybacks. And yet they have traded at like significant discount to the so-called consumption quality stocks. And, if you look at the last 1 year, 2 year, 5 year, 10 year, their growths have been significantly higher than the so-called, the paint stocks or the toothpaste stocks or the soap stocks. Even now, they trade at like 25-30% of the valuation at which some of the so-called, quality stocks trade. So our view is that, demand scenario is good. There is a tailwind. India is globally competitive there. Every company in the world is shifting towards a new way of doing business, which is a digital way. And in that kind of a scenario, the next 3-5 years look fantastic for this sector. But yes, you have mentioned correctly that there has been a so-called a mini over exuberance in particularly the mid-cap IT space. And, we feel that at this point of time, you have to be more stock specific in the IT space rather than buy anything and everything as far as the IT services space is concerned.
Since you own mid-cap IT, Sunil, Mastech, Root Mobile, would you be tempted to reduce your exposure in mid-cap IT, stay with IT but move up the value chain?
So I think, some of the stocks you mentioned, we continue to be large investors. And, I think ultimately the valuation also have to give credence to the growth rates possible. So some of these companies are growing at like 30-40% year after year. And, as long as we are confident that the valuations sort of are justifiable based on the growth rates, we would be pretty okay. I think the problem we have is when companies trade at 60-70 PE with 10 or 11% growth rates. If you're trading at like 25-30 PE multiple with 30%, 40% growth rate, we are more than happy to be investors.
If I shake you, you will still say no for Zomato, or somewhere you would be tempted to look at Zomato or some of those new tech companies?
So, I frankly adore the company. A few reasons. One is they have made all our lives so fantastically easy, in terms of consumers. And they have generated so much employment for the country. I think hats off to them for what they have created. At the same time, we have our own way of looking at stocks. I would not say old school. Yes, old school definitely, but we also are pretty okay in terms of investing in new age businesses. And, some of the names you mentioned on the tech side are a reflection that we are pretty okay in terms of looking at new age businesses. I think, but somewhere down the line, we do give credence to future profitability. And that is where, at least in few companies which have been listed recently, whether it was on the new age businesses or even on the so-called specialty chemical side, we find the valuations totally out of whack of at least what we believe in the future cash flows. And what we don't understand, including Bitcoins, we are better off not investing.
Investor activism or shareholder activism is now picking up in India, and I'm glad it is picking up. It's happened in developed countries, it is picking up in India. What are your thoughts there? I mean, could that lead to serious unlocking of valuations in some of the companies? I won't get into names here, but that is as a concept, do you think it makes sense?
Nikunj, I completely endorse. In fact, being exposed to the global scenario as I was on the board of CFA Institute for 6 years, US. And even earlier, in my earlier stint in the mutual fund side, we have been quite vocal in terms of some of the practices of listed companies. Unfortunately, at that point of time, it was not a big sort of a subject in India. But what is happening right now, obviously, is going to be most welcome. I think it is going to put companies on the guard in terms of ensuring or in terms of giving credence to the fact that there are minority shareholders who have an equal voice as the promoters. At the same time, we should be careful of not taking it too far. I have seen some small proposals of salaries increasing from 2 crores to 3 crores being proposed. I think as shareholders, we should be responsible. Keep our egos aside, be very reasonable and rational. And wherever we feel as shareholders that justice is not being done to minority shareholders, it's our right, it's our duty as trustees, particularly for people like us who manage public money, to fight for our rights. But, small things which are innocuous and which do not have major impact on the company's working, I don't think every resolution needs to be opposed. But it's a welcome move. A listed company has shareholders. All shareholders have equal rights depending on their shareholding. And it's, as I said, right as well as duty to protect that, rights for the benefit of our unit holders.
I'm cutting across sectors, Sunil, so that we can capture much more of your thoughts in today's interaction. You always like to buy pessimism, and especially when pessimism which is temporary in nature. Is the pessimism in auto slightly overdone, whether it is semiconductor shortage or what is happening in terms of this minor disruption because of EV?
So, Nikunj, to begin with, we don't have auto. In fact, we are significantly underweight. Notwithstanding the fact that the next 3-4 months are going to be excellent for the auto sector. We are heading into a phase where after 2 years we have a regular festive season. There is a pent-up demand. Interest rates are low, so that means your EMIs when you buy a car or a two-wheeler are going to be low. And you have a big tailwind as far as demand is concerned. On the headwind side, input costs are higher. So whether it is tires or whether it is metals or anything else, and therefore you will have to have an increase in cost or prices which you'll have to pass on. And you also have oil and specifically in India, petrol, diesel prices which are significantly higher, and that increases your cost of owning a vehicle. On the flip side, you have this phenomena of EV, which you rightly said, coming up. And actually, if you notice in the world, whenever disruptions have happened over the last 20, 30 years, it's been new companies who have been at the forefront of disruptions. So Kodak was a camera maker, but it was Canon and Nikon which came in with a digital camera. You had Toyotas and the Ford and everyone making cars, but it was Tesla, which is now the most valuable car manufacturer in the world because of its new age technology, which was EV. I think even in India, on the two-wheeler space, you have the new age guys like Ola and Ampere and Ether, which are launching the electric two-wheelers rather than the I would say the old leaders as far as two-wheelers are concerned. I think that all makes us believe that at best, unless some of these companies transition themselves into looking forward, maybe autos can at best be a trading kind of a buy.
It's such a great point. I'm just going to draw our viewers' attention here. Look at Tesla. The company perhaps did not exist 20 years ago, and because of disruption, they are the market leader in terms of EV disruption. Another classic example which we share with our viewers is that IBM used to dominate the entire computing market in America, but then Apple was able to displace it because they came out with a different kind of an experience and a different product offering even in the personal computing segment. So that's how typically happens. Like Sunil is saying, that when the disruption happens, the new disruptor comes and takes away lion amount of market share, and we've seen that time and again in many companies. Sunil, you've liked pharma in the past and you still own pharma. Is the pharma story getting slightly sour? First, there was over-optimism because of the COVID re-rating. Then the realization that, look, there is a problem in America, there is a price pressure, and that is something which is real and here to stay. That sector also has been on the wrong side of the market.
So, unfortunately, Nikunj, we keep on analyzing the market movement on a 2-3 month perspective. I think pharma did very, very well last year. You are right that there was a little bit of optimism built in. You had huge demand for one category of pharma products which were linked to the COVID side. APIs were in short supply, and generic did very, very well. You had a huge tailwind, and it was in a scenario or a period where other sectors were struggling because of lockdowns in the economy. And I think the sector did very, very well. I think as the economy started to reopen, as COVID started to subside, obviously the prices of a lot of these APIs and generics came off. There was already a huge, built-up of inventory in some of these medicines because of the fear factor. And therefore, the last 6 months, particularly for the pharma companies which were exposed more towards the COVID side of the treatment, see some degrowth or even a flattish kind of a growth. I think we are in a phase now where the non-COVID portfolio should start to do better. But at the same time, last 2-3 months have been sort of a cautious reopening, people are still a little bit wary of going to the hospital for some other treatment unless it is very, very necessary. But I think as we move forward, maybe in the next 3-6 months, you will see a comeback for pharma companies which were more exposed to the non-COVID portfolio. Again, this is one sector which, along with IT, is globally competitive. And therefore, for any long-term investor, I think this is a sector which cannot be ignored. Very clearly, this is again a sector where stock-specific dynamics are very different. And therefore, from time to time, you have different variants of the pharma companies doing well. I think right now, it makes sense to be a little bit more towards the domestic side of the pharma. But, you can't look at it from a 3-6 months perspective, because last 3-6 months has been purely a phase where, anything to do with the beta, opening up of the economy, a little bit of real estate, metals do very, very well. And the so-called, the beneficiaries of last year, like pharma, have taken a temporary breather.
I'll end today's discussion by quoting Charlie Munger. Sunil, he calls a effect called Lollapalooza effect, which means factors have to come together for things to move up. And that, I think, is applicable in the Tata Group. Chandra's leadership, businesses are coming back, commodity cycle back for Tata Steel, IT outsourcing increasing for TCS. Where do you see confluence of this factor in which business, in which company, in which group coming together?
See, as far as Tata is concerned, it is say, karma always helps. I think they're so good people, they will always get help from every quarter. And so happy to see the group do so well, one of the most ethical groups. The good thing, Nikunj, is that most forward-looking groups have realized that they can't be sitting on past glory. There's a huge move towards professionalizing companies. There's a huge move towards giving credence to the return on equity perspective. Otherwise, erstwhile companies used to just invest. The view was that, aage piche paisa ban jayega. I think that is now changed. They're professionally sort of analyzing whether return on equity can be, how capital can be allocated, because of their own internal view of giving respect to minority shareholders, as well as the recent activism. I think finally that is also playing off, and across the board, creating value which is determined in terms of market cap is also becoming a key KRA for most top management. Along with growth, profitability, I think market cap is now the third important point for any CEO's KRA. I think all this is a good confluence. Another thing is that India is coming back in the global investors' frame of mind as a single country, good sort of a destination, particularly after what has happened in China. We are a capital-starved nation. If we have the capital, we have more than enough entrepreneurship, more than enough passion, the fire to grow. And I think it's a great combination. Huge domestic market backed by capital coming in from overseas, and the entrepreneurship and passion of the domestic entrepreneurs. I think all we need is investors also to believe in this. And it would be so good to see domestic investors make money rather than global investors put money and make at the expense of the Indian consumers.
It sure will be. Sunil Singhania, always a pleasure having you on the show. Thanks for